Hi, everybody. My name is Joe Gifford, and I'm going to do a short video here to go over some of the loan programs here that we do here at Loan Factory. Anyway, I'm going to start here with the loan programs. I'm going to give an introduction to the loan programs that we have available and allow our clients to achieve their homeowners' goals. So let's talk about the VA loan, the benefits of the VA loan. Eligible veterans, no down payment for the loan, 100% financing, no mortgage interest insurance. No mortgage insurance on these loans. They do have a fee that's called a funding fee is what they call it. And they do charge that. And if you're eligible disabled veteran, then that's waived. You won't have that funding fee. There's flexible credit guidelines available for active duty veterans and eligible spouses. Also available for retired veterans and anybody that's served the required amount of time. And we'll go into that another time here, but there's certain requirements that you have to meet. It must meet a VA appraisal. VA will select an appraiser to come out, and well and septic standards must be met. Usually by your local health department will go ahead and inspect wells and septics, and sometimes a lender can require more, such as having a lab, a specialized lab, come out and test the water in the well. Other than that, let's move on here. Key features we covered: no monthly mortgage insurance, the max 41% back end DTI can go higher with strong compensating factors. Must be an eligible veteran or active duty service member, and flexible credit guidelines, typically 580 plus FICO. Okay, so next we have the FHA loan. FHA as little as 3.5% down for qualified buyers. Flexible credit requirements. Home buyers with lower credit scores may still qualify for FHA financing. Just depends on the lender. Some lenders require a certain amount, but typically 580 is what they're looking for, most lenders. Upfront monthly mortgage insurance is charged, usually 1.75% upfront mortgage insurance, and then your monthly mortgage insurance is at a 0.55% ratio. Ideal for first-time or credit challenge borrowers. They have a little flexible credit requirements you can navigate through. And there's also down payment assistance programs to help you out with the FHA loans. Several lenders now offer the down payment assistance program that they'll take that 3.5% and roll it into a second loan. They won't roll it into the first loan, but you'll have a first loan and a second loan. And normally they'll amortize that second loan out 30 years, giving you a very low payment on that loan. Front end DTI up to 46.9%, up to 47%. It has to be less than. And the back end DTI up to 56.9%, just under 57%. And that's usually the highest you can go. What most lenders usually not let you go that high. Mortgage insurance premium required, and we talked about that, to 1.75% on the front and the 0.55 monthly. Lenient credit history and available to first-time and repeat buyers. You don't have to be a first-time borrower to qualify for that. And let's move on to conventional. Okay, understanding conventional loans. Conventional loans basically are a program you can go 3% down, they have now, or 5% down. Conventional loans will offer good terms for strong borrowers. And like I said, as little as 3% down now programs, but you'll get a higher rate at that 3% down. No upfront mortgage insurance. However, you will have PMI and it can be removed when you hit that 20% equity rate. So if you put 25, 20, or if you put 20% down, you won't have PMI. Put less than that, you will have PMI. And it's factored on how much you put down, your credit score and all that factors into what your mortgage insurance will be, your primary mortgage insurance will be. Higher credit scores are normally required. They usually want a 620, and conforming loan limits must apply, must be at the ratio of the conforming loan limits for that county. Usually each county has a conforming loan limit. Okay, like we said, 3% down, front end up to 36%, and the back end DTI 50%. They will not go higher. PMI required if LTV is greater than 80%. It can be removed if you have that 20% equity in a property. Strong credit profile, they normally require 620 plus FICO. And other than that, let's move on to the USDA loan. The USDA loan is a 100% financing program. It's only eligible in rural areas, and you can go on the eligibility USDA map. Just Google USDA eligibility map, and you can plug the address in there, and it will tell you if it's in a authorized or approved area. So the property must be approved. Income limits apply. It's basically based off of your family size and your income that you take in to be eligible. There's a couple different types there, but mainly they're looking at your income and the family size. Property and the borrower must meet the eligibility. We talked about that. Great for low to moderate income families. So let's go next slide. It goes by the county and household size as far as the income limits. Each counties have different numbers, so you have to basically look up your county, look up the eligible income limits and household family size, and it'll be based on the size of your family. Property, like I said, go to that eligibility map and make sure you're in a rural area. They're very strict with their front end, back end limits. 29% front end, 41% back end. Mortgage insurance required, but it's at a low cost of 0.35% annual, lower than the 0.55% on the FHA loans. So you'll have a lower, mortgage insurance rate there. Okay, so DSCR loans. Let's go over the DSCR loan there. DSCR loan is basically for rental properties. If you're going to purchase a property, you want to rent it out, you're an investor. It measures the income against loan payments, ensuring financial stability for the borrowers. The loan eligibility criteria, higher DSCR indicates lower risk. So what you're looking for a higher than 1. Usually they want to see a 1%. If you go below 1, you're usually looking at a higher interest rate, or they won't do it. But you're looking for something 1 or above. That means that your cash flowing there and your property's making money. You're not losing money. So with the DSCR loan, they're not going to look at your tax returns. They're not going to look at your income. They're not going to verify your job. It's basically the property, and that's why they want it to cash flow. They'll go lower. It says some lenders there will go lower, but you'll take a pricing hit on that. For investment properties only, it's not for primary homes. You can't live in it. Normally 20-25% down. There's programs out there at 85% LTV, meaning 15% down. But there are a couple investors, so you can go up to an 85% LTV. Rates starting as low as 6.25% right now, and they're down there. But you want to make sure that usually to get that lower rate, you have to have that 20% down, even 25%. With some lenders, it just depends on the lender there. But no tax returns, no income docs. It's just basically your credit score. So, they're looking for a credit score, 660. You can get it done at a higher rate. You're going to have a higher interest rate. So, and there's some will go lower, but you're going to pay a higher rate on that. So, Other than that, let's talk about fix and flip loans. There's short-term financing for property, for doing rehab. Go in, do a rehab on the property, turn around, you can rent it out. It's called a fix and flip and hold, or you can turn around and sell it, flip it. Either way, it's short-term financing, normally 9 months to 12 months, to some will go 24 months. Over 9 months, you'll take a hit. They want to get it flipped in 9 months. However, with these fix and flips, what you're paying, the cost of the loan is a little higher there. The fees, you pay some high fees, but that's because that's where the lender's making their money. They're making it short-term wise so you're going to pay it up front, the fees there. Let's flip this slide. Okay. Some will go up to 100%. There's a couple lenders that will go to 100%, but it depends on the area. They're not looking to do rural areas. It's more metropolitan areas, but you can get 100% financing on these fix and flips. The kick is they want you to have 15,000 in reserves in the bank sitting there, knowing you have some money to move. But usually the 75% is the max ARV goes. And the short term, 6 months to 18 months on the loan. No income docs, fast closing, great for investors with experience or strong equity, strong deal equity. There are some, they will do inexperienced investors, but they're looking at the property. If you got a good deal and you have the credit score, normally above 660, and they're not really, some aren't looking for experience. So you can do this loan with no experience, but your ARV won't be 75%. It'll probably be 65%. If your credit score is above 700 and you have no experience, this one investor will do 70% ARV. Let me explain ARV. If you have a $200,000 house, the ARV is 70%. The max deal loan on that property is $7,000. So they'll loan up to, $6,000, 30%. If you're at a 70% ARV, they'll loan is $140,000. So that's basically how it works. They'll take 70% ARV of the $200,000 price. And that means they'll finance up to $140,000. That's for the purchase and the repairs. Okay. And other than that, the other one is bank statement loans. Bank statement loans are mainly for self-employed borrowers. And we don't have nothing on here about the bank statement. Let me just explain a little bit about bank statement loans. If you have a borrower and they're writing too much stuff off, usually on their taxes, most people in business do that. They don't show too much of a profit. They're writing everything off. There's 12-month bank statement programs and 24-month bank statement programs. 24-month bank statement programs, you'll get better terms. Usually on these programs, they want a high credit score. They're not going to do low credit scores. They want to see something a little higher. They won't look at your tax returns. And they'll go up to 90% LTV. Some lenders will go, depending on your credit score again. And if you got a low credit score, then that LTV will be lower. Flexible terms, higher loan amounts. But, they'll basically take your bank statements, use that, and then they'll usually cut it in half. So if you have 10,000 deposits, they'll cut it in half and give you a $5,000 a month income. Just, basically how it works there. I'd like to thank you for attending. Any questions, feel free to email me or text me 270-318-4388. Thanks for watching.